consideration you might think about is, aside from the capital event possibility of selling shares that you don't want to sell, what if you have to send them cash to those shares? It's something to think about, for sure, right? What if you inherited those shares or they had some kind of sentimental reason and you didn't want to deliver those shares? And that might be a circumstance where you would say, don't sell covered calls against those shares that you don't want to live or don't want to deliver. That's just the simple way to put it, right? Okay. So let's talk through this in terms of position side. We'll talk about how many shares you need to have in order to be able to sell a covered call.
So as far as a covered call, each option contract obviously represents a number of shares. So if you're selling one option contract, you have to have at least 100 shares for it to be covered in this case. And it kind of goes up in the same way if you're doing 2 or if you're doing 5. You need 100 times that amount of shares in order to cover that possible obligation.
And for the most part, those shares need to be in the same account. You can't hold 100 shares over at brokerage X and sell a call option over here at Charles Schwab and expect that those shares over there at brokerage X are going to be covered for the shortfall that you sold over here at Charles Schwab. That makes sense? If you have that circumstance, where you've got long shares over here and you're selling calls over here at Charles Schwab, you see the branch guys back here? Ernst and his crew are going to be more than happy to talk to you about moving your assets, those long stocks, into a position, into a portfolio of Charles Schwab. I'm just saying. Shameless plug for a branch representative in there, right? Any questions? Okay. So that's a good question. The question is this: what if you have multiple accounts, say family trusts or other types of accounts that have here at Schwab, and you're selling call options in another account? Now, Rachel, this is a conversation with you in your previous role as a mutual investment strategist. You had conversations with clients all the time, right?
Exactly. And you do have to have them all in the same account for it to actually be considered as covered. So you can't have the option for one account and the stock in another. They have to be in the same account. So we'll go through some different ideas of how you acquire the stocks or how you acquire the options in each account. You could.
So the question is, yeah, can you move those stocks to satisfy the obligation? And again, if you've got conversations or questions about that in your account, the branch guys would be more than happy to have that conversation with you about those specific circumstances. Okay. So let's talk about how we construct this particular strategy to put together a covered call. So Rachel, I know one of the examples that you and I talked about is this particular stock right here. This is Johnson & Johnson. And Johnson & Johnson is one of the stocks. Maybe some of you already have this stock. And again, this is not a recommendation, this is an illustrated example. Some of you might have this stock or stocks like this in your portfolio that are dividend-paying stocks, for instance, that maybe would be more defensive. Johnson & Johnson right now, at the moment, is performing more like a growth stock or a biotech stock than a defensive consumer staples stock. It keeps moving higher. But you might own the stock. The covered call trade begins, at least in the way we're going to talk about right now, with the ownership of that underlying stock. But when we talk about selling an option, there are a couple of things we want to pay attention to. So I'm going to put on this chart, Rachel, implied volatility. So I'm going to put on my fixed it, that's why. Hang on. Let me change where we're looking at this chart. While Rachel talks a little bit about the mechanics of selling the call option.
And so he's going to pull the implied volatility. We can kind of start there first on how implied volatility is going to affect that short option. percentile, which takes the implied volatility of the last year and really breaks it on a scale from 1 to 100 on how high or low it is relative to itself. So that's kind of one of the first steps you could do to just check yourself in the market environment. And then as far as just strike selection and some of the other components like that, I know we're on a chart right now. One of the things I would like to do if I'm selling an option is to zoom out a little bit on the chart and see if there's any levels of resistance that we need to be running into, because that may be one of the ideas that we use for selecting a option strike on the short side.
Okay, so you said something important. Two things. Everything is important. Two things that were key in understanding. One, at the bottom of this particular chart on Johnson & Johnson, I put on a technical study called implied volatility, IMP volatility, implied volatility. Now remember, that's how much premium the market makers are adding to that option premium based on expectation of movement around an event or on an emergent basis if there is news that causes the price of stock to go up or down. Remember, we looked at the VIX, and we saw that the big VIX spike on Friday. The VIX is a measure of the implied volatility of the S&P 500. The VIX talked about it too. This blue line we got at the bottom of the chart is the measure of implied volatility on Johnson & Johnson. Now, you notice there's that little blue and red pair of icons right there on the bottom right-hand corner of that chart. That's earnings, right? Remember we talked about that yesterday? What's implied volatility doing going into that earnings announcement? Rising, isn't it? What do we expect implied volatility to do following that earnings announcement? Why? Because now the news is out there. Here's the thing. Even if we knew what the earnings announcement was going to be, we know how the market is going to react to it. We don't. How many times have you seen a company have good earnings numbers and it gets punished? Or terrible earnings numbers, and somebody comes in and starts buying it up. So, volatility is volatility for a reason, because the price of the stock could move. So pay attention to that. Big moves and have lots of implied volatility. It's because the stock can make big moves. So temper your expectations when it comes to high implied volatility and covered calls. Because do we really want the stock to blow the doors off of things and keep going up significantly when we're selling a covered call? Probably not. We want the stock to stay kind of where it is. We said something secondary to that, which was we might sell at or below a level of resistance that might suggest that the price of the stock might stay at or below that level. In which case we don't have the shares all away from it. Where, Rachel, do you see, I know that from your technical analysis perspective, where would you see perhaps a level of resistance that you could draw to here, and how would you base that level of resistance?
So a couple different things. You could look at the flag pattern that kind of formed and measure the flag hole.
Okay.
I think one way that we look at resistance or price target of any traders that are trading the price pattern.
All right. So we might come back in here and we might say, look, there's that flag pattern that we were talking about yesterday, right? That kind of longer rally up, goes sideways with consolidation, and then rally up again. So that distance might put us up there around that 200 level. Is there anything significant, Rachel, about that 200 level?
Well, traders love round numbers. We talked about this a little bit yesterday, and so we may find that those levels of resistance are those nice, cheap round numbers that we see. So 200, I think, would be a great line that traders could see when looking at this chart.
Okay, so the stock's currently trading at 190. We've got a resistance or potential resistance up around 200. So as we're starting to plan this covered call trade, that's where we're going to start thinking about potentially selling this call option. Now I know in your mind you're going, but yeah, that's a long ways away. That gives you some room for this to $200 strike call option, and the price of the stock goes up through 200, and I have to sell that stock $10 higher, and I got paid for selling the call option that allowed me to do that? Isn't that cool? That's really cool, because now you're getting the premium plus the gain in the price of the stock. So let's look at that option change. Oh wait, by the way, the implied volatility is relatively high here relative to where it has been. In fact, it's just about minus this big spike in April. Implied volatility is just about the highest that it has been over the course of the year. So we're selling a lot of premium, a lot of juicy premium. So I'm going to go to the trade tab, and then we'll look at these options. Now, the next thing we might think about is duration. We think about how long we might consider selling the covered call out in time.
Well, I know when you were going through Greece, as you saw that, we saw that there was a curve that took place, and you gave the reference of the ice cube and the expiration being the key that's going to melt it. We saw that curve really happen to get closer around like 30 days out from expiration. So that may be one of those areas that we look at in 30 to 45 days to give us that sweet spot of that time to pay that's going to kick in, because as an option seller, the time to pay works in our favor. We want to see the day out of our option because we want it to expire first.
Okay. So we might take the term we said, look, if I'm the buyer of an option, I want to buy more time. If I'm the seller of an option, I want to sell, you said, as that curve is starting to accelerate to the downside. So one of the considerations we might think about is selling maybe in that 30 to 20, maybe 40 to 25 day to go until expiration time frame. So I'm going to kind of come back over here to the left-hand side. I'm going to look through this option chain, and I'm going to say, hey, I've got an expiration. There's 41 days to go until expiration. Now the balance, this is the balance. We've got to manage. 41 days to go until expiration means that the stock has 41 days of potential movement. It can take the price of that stock higher or lower. There's more time for the stock to make a move. Now, we don't have to hold on to this short option all the way through this 41 days. We can buy it back and eliminate that obligation. But that's a long time for that stock to kind of be hanging out there with that short option and could put that trade against it. So you might consider balancing the amount of premium that you can receive for selling an option 41 days ago until expiration with maybe selling a shorter dated option that's going to have a more rapid rate of time decay, and then doing it again. Now you've got a shorter period of time to release the stock and move. Okay, so it's always a consideration to think about this. But for the purposes of this discussion, I'm going to go to that 41 days ago until expiration, and we said the 200 strike, right? As a level of potential resistance. If I go to the call side of the 200 strike, I'm able to bring in, I can see probably about $1.90 per share times 100 shares for selling that call option. That's kind of cool. Now, I also want to do one other thing. I want to look at that delta number right there. Because that delta number is about 26 delta. And what did we say about delta in terms of probability of an option being in the money at expiration? Yeah, that's about a 26% likelihood that that option is going to be in money at expiration, which means that it's what likelihood that it's going to be out of money at expiration? 74%. Highly probable, right? Highly probable that that option is going to be out of money at expiration and you keep that premium. If I were to go closer to the at-money position, notice my delta goes up. That's a lower probability of success. If success is this option staying out of money, that's a lower probability of success of that option if we were to sell at a higher delta. If I go further is, well, wait, how much difference would it make if I were to go to a, say, for instance, a weekly auction in terms of the amount of premium? Okay? Again, this is part of that balance. The further out time I go, the more premium I'm going to get because there's more time value, right? So let's just take it the other side first, the other direction first. So if I go out to, say, for instance, 21, so it's 160 days to go into level premium. At the 200 strike, cool, I'm getting $5 worth of premium. That's better than $2. Oh yeah, again, our delta went up. The probability of success went down. You got more premium. It's always a trade-off. Now let's go the other direction. You said the 7th of November, which is 27 days to go until expiration. If I open up the 7th of November, that's the 200 strike. I'm getting $1.30 roughly, and my probability of success is a little bit higher. See how you can tailor this covered call to match your expectations by adjusting the duration and potentially strike pressure. I can't hear you. Okay, good question. So the question was, should we be looking at open interest and liquidity? Yeah, it's always a good cross-check to see open interest and liquidity. Again, bid-ask spreads are going to be an important consideration in this scenario. Pay attention to how wide those bid-ask spreads are. Bid-ask spreads are. Okay, so I'm going to still stay with that 21 November, the regular November expiration. It's been traded for a while. It's been listed for a while. So we're going to stick with this one. That's a fairly narrow bid-ask spread, to be fair. So we're kind of at that point. Now, data, we're going to lose about 5 cents of premium out of that, or 5 cents of value out of that option premium per day. So that's working in my favor. And if the implied volatility goes down, we'll lose about 21 cents per cent estimate. So we can put this trade on. Now, I don't know that I've got one JJ long position. I might in this particular account. I do. I got 200 shares in 300, 400 shares in Johnson & Johnson in this particular thing. So, Rachel, how many contracts could I sell? Cover calls. Yes.
You only have
400 shares.
You only have 200, so it's, yeah.
What do they have there?
You could run it out by trade.
No, I got there's 200. Oh, no, that is my total. I was looking at all this up.
It's just broken out by trade. So you have 200, so you can only do 2 contracts. So just take the amount of shares divided by 100, and you have to round down obviously to that. Like, so if you had, let's say 250 shares, you could still only do 2 contracts because you don't have the other 50 to do 3. So in this case, you can only do 2.
And I don't have to sell cover calls against all of the shares that I have in my account. I can sell 1 contract and leave 100 shares uncovered and still have that ability to have that stock move higher. So again, you can tailor this trade to match what you want to accomplish in this particular scenario. So we might create this trade. So I own the 200 shares, and I would come in and I would sell, just by clicking on the bid price, that 1 contract in this case of the 200 strike call option. Now, I'm going to click on confirm and set, and I'm going to bring this order dialog over here so that we can see my maximum theoretical gain in the sale of the call option is the amount of premium that I'm bringing in for selling that option. But if the price of the stock will go up, I'm still getting that stock price appreciation from where it currently is up to the strike price, all right? If that stock gets called away. Here's the challenge. You remember how seductive that infinite order was when we were trading long options? And it said, infinite maximum gain. Here's the other side of that. We're selling a call.
Infinite maximum loss.
I love it.
Yes.
Good job. We have that potential to take infinite maximum loss. Now we don't because we own the shares of stock. But if you were to sell a call sell a call option and you did not own the shares of stock, then that's called a naked call.
Infinite maximum loss.
Yes. And one of the situations is you may not be able to sell a naked call, depending on the type of account you have. You might not be able to sell a naked short option for good reason. Could the price of stock go up indefinitely? That is likely to go into the family, probably not. But could it continue to go up? Yeah. And you could take a substantially higher loss. Okay, so let's put this order together as we place this trade. We're going to go ahead and click on confirm and send. We're going to fire this order off. We know that we own. Oh, thank you. I already did confirm. Thanks, Rick. Okay. Now what I'm going to do is I'm going to go over here to the analyze tab. The analyze. Take a look at positions that you might have. Let me take that strength off of there. So look at positions that you might have and evaluate what those trades are doing or what their sensitivities are. I talked to somebody about being able to model things like time decay, price movement, and the analyze tab is one of the places that you do that. I don't want to get too into the weeds. We've got some great webcasts to talk about this. What I'm going to do is I'm going to add a simulated trade here, Rachel, on this stock at that 21 November expiration. I'm going to add that simulated trade right here down into the mix. In fact, I'm going to do this and we're going to go to the risk profile. So this particular chart, as we're looking at it, is profit and loss on the y-axis and stock price movement on the x-axis. With profit and loss plotted over the price of the stock. The most that we can make on the trade is if the price of the stock goes up to 200. Beyond that, we're capped. We have to sell the stock, we brought in that premium. But if the price of the stock goes down, brought in a little bit of premium to offset that downward movement. If we hold on to the stock, and the stock continues to go down, and we're riding that bus all the way south to the west, we're losing money in the stock, aren't we? This basically is a covered call. Is this a bearish or a hedging strategy?
Not a hedging strategy. We have collars for that, puts for that, but it's more of a neutral, slightly bearish and slightly bullish type of trade.
The big driver of the covered call trade is the ownership of the underlying stock. You own that stock. What do you want the shares of stock to do? Go up. The risk in a covered call trade isn't necessarily in the shares of stock being called away. The risk in a covered call trade is in the price of the underlying stock going down. So it begins with direction, and then it continues with bringing in that premium to manage that risk or to give us some income. Now, this might be the scenario, trading this trade like this. This might be the scenario that we would use to either create a let's get paid for putting in a limit order to sell the stock if it goes up, or doing this again and again and again to generate income for the purpose of buying more stock, or continuing to grow your portfolio, or using that capital to bring in the premium, or regular operating expenses. Is there another way that we can go about using a covered call that is maybe a little bit more aggressive, even if you want to think about it from a speculative standpoint, where we don't own the shares of stock to begin with? What do we call that?
Yeah, so we can do that. If we don't own the shares of stock, we could do possibly like the credit spread. We can do that, or we can do, well, that's another strategy that we're not favorite. But what we will buy right, so that could be where we can buy the stock at the same time that we sell the option as well.
Okay, so I know we placed an order on Pepsi yesterday. trade tab, and we're going to do this a couple of different ways. So we're on Pepsi. Again, duration is going to matter here, like the time that you're in the trade. So let's look again out at that maybe 21 November or the 14 November time frame. 21 November gives a little bit more implied volatility, so a little bit higher premiums. I'm going to buy the stock. The stock's currently trading about 150. We're going to do better than that, buying the stock at 150. Because if we're buying the stock at 150 and we are selling, what did we say that was? What was our resistance level? About 155, 156. We've got a 155 strike. Now, we're bringing in $2.57 premium. What is our net cost per stock per share of stock?
50 minus 257, so about 147.5. Okay.
So instead of buying the stock at 150, we're buying the stock around 147. So you can do that here on the traditional platform. You can go to the spread. Somebody asked me about this spread function right here earlier. And we can change that spread to covered stock. The covered stock then displays the cost to buy the stock and sell the covered call at the same time. So here's my 155 strike. I can buy the stock and sell the covered call, sell the call option at that 155 strike for a net debit of 147.32. You got the numbers right. You got the math. You're pretty good at math.
That's why it's graders.
You're better at math than I am, that's for sure. I don't do simple math very easily. That's why I round.
Yeah, you like round numbers, traders like round numbers. It's easier.
And if we take this and we right-click and we send this to the Analyze tab, here's what that's going to look like. And when you do this with high positions, here's our covered call trade, our buy-right strategy. We know that if we do set slices to break even, my break even on this trade is 153.50. That's where we've got to get to in order for this stock, for this trade to make money. Beyond 155, we don't make any more money on the trade. So this might be a shorter term trade. Now, some questions that come up on this particular strategy might be, wait a second, do I have to just let that stock go all the way to zero, or can I do something?
No, you can definitely do something about it. And you can close out that option before expiration, or we can roll the option to a different strike price and or a different option expiration as well.
So I'm going to go back over to my monitors after because I think in my extra puts and cover calls, maybe I've got that in my related workshop. Let me just double check. I think I had X on one. Let's see if I've got another covered call trade here. What is the do with each part of the spread? There's an air one, and some Western Digital. Okay, here we go. I own shares of Western Digital. Oh, that's a short one. Oh, I have to be Rachel. Ready to go. Why did that kick out on stuff? So let's take that same trade that we were doing right here, this right here. If I wanted to roll this order to continue to take advantage of that price increase, the price of the stock continues to go up, I can buy back the short option and then sell another. I can do that in one trade by creating a rolling order. The rolling order doesn't function as a magic wand in eliminating transaction costs or anything else. It's just simply buying that option back and selling another one and extending the trade, yes? I could simply buy back the call option and let the price of the stock continue to run. So when you're managing a covered call, one of the considerations is what is your current direction assessment of the underlying stock? Because the driver of covered call trade is what stay put. Put a pin in that for just a minute. That's next. Okay? Hang tight for just a second. We can create a short put position. Now, the other side of this coin is, wait a second. If the risk in the covered call trade is that the price of the stock can go down, why don't I just put a stop loss order on the price of that stock going down? Is there a problem with that?
Yeah, because we don't have the option yet. Or we don't have the stock yet.
Okay. Or if we did own the stock, like we did on Johnson & Johnson, could we just put a stop order on that underlying stock that would trigger us out of the underlying stock if the price of the stock went down?
No, because we have our options trade on it as well, which gives us our option to sell.
Oh, so what you're saying to me, Rachel, is there is a possibility that if I were to put a stop order on the long stock position, and that stop order gets triggered, the price of the stock goes down, then I might be left with a short option, short call option, right? What did we call short call options when we don't own the underlying stock? Naked call options.
Infinite maximum loss.
Yes, as he said, we could, and this is a consideration, we could be in a situation where if we put a stop loss on a share of stocks, or stocks that we own, and we sold covered call against them, where we could end up in an inadvertent naked position. I don't know about you guys, being naked on purpose is bad enough. Being inadvertently naked is a little bit worse. Especially when I have a wide bid-ask spread. You guys need to laugh. Like you're coming in right late in the afternoon. It's after lunch. It's turkey. We need to get you up and going. So thank you for letting me make that vaguely inappropriate joke and getting you to laugh a little bit. But cover calls. This is. I know that you have a bunch of conversations with clients about cover calls and about their use in the portfolio. I like to think of cover calls as kind of the gateway drug to trading options. How many of you traded cover calls before in your strategy? How many of you also raised your hand saying you have a long stock portfolio or now considering using a cover call strategy to generate income in your portfolio? See, it's the gateway drug to trading options. It really is. It gets you started in a way that allows you to generate that income. Questions? Oh, excellent question. Could you avoid being inadvertently naked if you created a stock order that closed both? And the answer is yes. The caution there is, have you ever submitted an order to close a position and it hasn't filled? So if you were to put in a stop order and that order doesn't fill on the stock side, you don't sell stock, or you do sell stock and it doesn't fill the closing order on the short option, you could still be stuck with that inadvertent short call. So just as a matter of course, close the position that has the obligation first, eliminate the obligation, and then close the stock position. Don't do it the other way around. Eliminate the obligation first, then close the stock position. Question over here.
Question. I have exactly the same role, but why does it say diagonal here? Take a look here, you see spread covered, but mine diagonal. How to change to covered? It's a covered call. I want to roll it, for example. You see here, he has covered spread. I have diagonal and custom. Why do I have covered? Do you know?
There's a tab that
Which one? For example, all my positions are here. This is covered calls. For example, if I want to roll, I click right click, yes. I don't know why it's not working. Ah, why it's not clicking? Let's give it this. Create rolling order. It's correct. Then sell. But again, it's diagonal. Why in his it's covered?
this screen kind of looks different, but I thought that there's a
So
when you
the
do
question is
this
this.
that there
You're
is
selling an option on a stock that
you
you
can
think
click
will
on the
go
diagram
down
and can you
otherwise,
click on the spread?
and you look at those
It's not
strike
clickable.
It's
prices
You
not
can
that are
clickable.
available.
no. I can put calendar of
Oh, right
customer.
here, single order. Let's see.
50 cents increase between your strike prices.
Oh,
Which strike
single
price did you
order.
choose? So
But what does it mean plus
ultimately
two?
that's what it comes down to. Which expression?
That's
And
why
one of the things you might
No, it's
consider
not.
is
you don't have a
where
row
is there the
options.
greatest amount of
Did you try?
liquidity?
I haven't tried
Where
that. I
is
haven't
the
done
most
that, but
liquidity
there
of the
there is
narrowest
one I think that
bid-ask spread
it's
that you can
it
get.
kind of
And
tells
then
you
when
if
you
it's a
start
spread or
rolling,
it's
if you
a
think about
conduct
rolling that
or a tip
strategy
dip.
Ah,
forward,
it's here.
how do you
I'll show
roll
you. For
and how
example,
do
when
you
you
manage
click
that
like
roll?
this,
And part of that has been
like
recognizing the
here with a
rolling
cell here,
order
Exactly.
depends on the
but still there is no
liquidity
covered.
of the strike and the
Ah,
expiration
maybe like
you're
this.
rolling.
Lack of cover.
So
Right. So you can then
One second. Let's
there's
dig
really
it.
kind of three considerations.
But it
One,
doesn't allow to
how much
roll.
premium
For
you're
example, I
taking.
want to roll from here.
Two,
oh the
what's the liquidity of that strike that you're selling to bring that
No,
premium
it's
in? And
create
three,
a
are
roll
you
strategy.
at or above a level of resistance? And maybe that
you
becomes
understand
a
what
level
does
of
it mean?
priority.
That's just the probability.
Yes, I know, but how to read it? Do you know how to analyze?
Uh, I'm not
No.
that great at that.
But still, he is not clear. Again,
Now, one thing that this standpoint is
Outside, there's
ask him. He said contact chat support, but chat support is not working today. You see, support
oh
is not available. That's okay, thank you.
sorry.
I'll ask him later. Thank you so much.
as a means to set that bid order that targets the out of trade if the stock goes in the direction that you want it to go. Then what do you do? What happens then if you have to deliver those shares of stock because the price of stock is going up and the stock is still going up and you want to get back into that stock? Wouldn't you like to see a way that we could buy that stock back and then do it again? Wouldn't that be cool? Oh, wait, it's like they put a limit order on the purchase of the stock again, right? Okay, so let's do this. If you want to learn more about that particular strategy, we're going to talk about that strategy. We're going to do it after this break. Yeah, real quick. Let's give Rachel a big round of applause. Thank you, Rachel. What I want to do now, really quickly, I'm going to bring it right up here in just a minute.
Subscribe, like,
Interest in time,
please,
I
like.
see